Good morning, everyone. On behalf of ICA Global Udan team, it gives me immense pleasure to welcome all the distinguished participants joining us today for the 42nd edition of the Global Udan webinar series. I am CA Surajas and I have the privilege of being your moderator for today's session. The world of finance is evolving rapidly, and one of the most dynamic and high growth areas today is the private equity and venture capital ecosystem. As businesses increasingly seek alternative source of capital and investors look for innovative opportunities, chartered accountants are uniquely positioned to play a critical role in this ecosystem as advisors, transaction specialists, valuation experts, compliance professionals, and strategic partners. Today's webinar is designed to provide valuable insight into how Indian chartered accountants can identify, understand, and capitalize on the emerging opportunities within the private equity and venture capital space. Whether you are in practice, industry, consulting, or aspiring to expand your professional horizons globally, this session promises to offer practical perspective and actionable knowledge. We are privileged to have with us an eminent speaker who brings extensive experience and expertise in this domain. I am confident that today's discussion will not only enhance your technical understanding, but also inspire you to explore new avenues of professional growth. Before we begin, I would just request all participants to post their questions in the Zoom Q&A sessions. We will try to address as many questions as possible during the interactive session towards the end of the webinar. Thank you all for taking the time to join us today. Let us make this session engaging, insightful, and enriching for everyone. Without further ado, let us begin today's session. It is now my distinct privilege and pleasure to introduce our esteemed speaker for today's session, CA Harsh Thakur. CA Harsh sir is a finance professional with a truly global perspective whose career seamlessly bridges investment banking, academia, fintech, and international capital markets. His professional journey reflects a unique blend of industry expertise and academic excellence, making him exceptionally well positioned to guide us through today's topic. He currently serves as the program lead for the MSc Finance and Investment program at the University of Bristol's Mumbai Enterprise Campus, where he plays a pivotal role in bringing global finance education standard to aspiring professionals in India. Over the years, he has been associated with reputed institutions and organizations, including the University of Wollongong, RBL Bank, Kotak Mahindra Bank, and GM Financial, gaining extensive exposure across banking, investment, and financial markets. Beyond his corporate and academic accomplishment, CA Harsh is a recognized thought leader in the fintech ecosystem. He has been honored as a 30 under 30 fintech leader and has represented India Finance at prestigious international platforms such as the Global Fintech Fest, Singapore Fintech Festival, and the Indian Digital Summit. Through his research, teaching, and advisory work at Leonum Advisory Private Limited, he continues to contribute significantly towards helping professionals understand and navigate the evolved global financial landscape. So, ladies and gentlemen, please join me in extending a warm welcome to CA Harsh sir. Sir, we are honored to have you with us today. The virtual stage is now yours. Thank you, sir.
Perfect. I'm just checking if, yes, it is done. Thank you, CS Suraji, for this kind of warm introduction, and thank you, ICI. Thank you, Gunjan Madam. Thank you, the chairman of the committee, CA Sanjib Sanghi ji, the vice chairman, CA Ruvatia ji, Thank you for this honor, and it's good to be back after I think almost a 4 month kind of a break from this Global Udan series, and for a new topic entirely. So I think let's dwell into it. And thank you for all the participants, for all the CA members for joining in. I know it's sort of the end of vacation season for us here, and it's typically Friday morning, and you're sort of getting used to, or sort of trying to wrap up your entire weekend to make your weekend sort of very comfortable. So that's I mean, I'm really grateful. Thank you for being all for here. Now, I'm not really here to talk about how does a private equity work, or how does the entire landscape of private capital ideally works, but we are sort of going on to sort of see a journey. Now I've divided the entire sort of so-called presentation on this 2 hour discussion into 4 stations. So we are going to really navigate from point A to point B. Like I said, it's still vacation zone, and we're trying to move from point A to point B always. So, and I'm standing here, so, nothing to do with any of these kind of titles which Suraj just mentioned. So it's, just one idea, which is trillions of dollars of private capital move around the world every year. I'll tell you those precise numbers right immediately into funds, into companies, and back out again as returns. And not a single rupee or not a single dollar of it can really move without people who exactly like us, like Indian chartered accountants, what we're trained to do, which is structure it, value it, audit it, account for it, and then finally report for it, right? So that work entirely is ours for us to really capture. Now, I've divided the entire so-called presentation into 2 parts. We will talk about a bit on the employability part of it as well. So if you are a young member, or if you want to transition from, let's say, an audit profile or an FP&A profile to, let's say, on the private equity side of things, how does the employment lens in India and globally, of course, would look like for somebody who's an Indian chartered accountant? And secondly, of course, for the members in practice, what's the kind of share that we can get for ourselves globally, right? So, and I'm, the entire committee, as well as I, have a very firm belief that, Indian CAs are not just spectator to the entire global capital flows, but we're actually, sort of the plumbers for it. Now, yeah, so the screen is here. Now you see 4 really big numbers. So the first number is, the $17.5 trillion. That's the global private capital assets under management as of the end of 2025. And it has actually more than doubled since 2018. Now, I mean, I have a specific theory of why there is so much of fund involvement, or there's a lot of movement of capital, specifically on the private side and not so much on the public side. So if you look at Indian markets, or Indian equity markets for that matter, they have been sort of sluggish, or they have been sort of flat for almost 18 to 24 months now, right? But if you look at the Indian private space, which is the venture capital or the early seed investors, or just broadly private equity for that matter, the story is a lot more different than what we see on the public space. Now, like I said, I have a theory to it, so which is what I'm going to sort of slowly boil down that entire sort of narrative, by the end of this 2 hour sort of presentation. And what you see in the next number is, $8 to $8.5 trillion. That's the alternatives assets under management, growing 10 to 15% in 2025, outpacing all traditional assets. So I think very recently, I think PPFAS mutual fund in India was, I think, the latest fund to launch an alternative retail only participative fund. It is acting like a sort of a part of fund, but I mean, that's the last news which I remember reading for the Indian space. So again, a lot of traction on the alternative side. $3.7 trillion, that's the private equity dry powder committed, but uncalled at the start of 2026. Now, there is a very specific language, or the lingo of how this kind of world operates. So there are specific terms which are very akin to the private space only. Public markets, we have a different language or a different terminology as such. So dry powder, again, it varies definition to definition. So for example, let's say Bain puts all private capital dry powder their report suggests it's $3.9 trillion and not $3.7 trillion, right? So that detailed definition of how it works in India, how it works in Cayman Islands, how it works in Delaware, for example, that's where our niche, or that's where our skills sort of ideally rise, right? But then dry powder is actually, they have a commitment that this is the amount that if we want to deploy in buying assets or investing in other funds, we have that kind of a armory all set up. So that amount is roughly about 3.7 to $3.9 trillion. And 44% rise in global buyout activity in 2025 as the deal market reopened. And I'm sure we are all following news. So what's happening with SpaceX, specifically the IPO kind of buzz? If you look at their valuations, it's just gone. It's crazy. But crazy is not the word. If you were an early stage investor for SpaceX, you would have gotten probably the best exit so far that we've ever seen, let's say, on this planet, right? So, I mean, that's the kind of, power in terms of multiples that you end up getting, multiples on your invested capital or MOIC. That's the kind of returns that you end up getting. Do you expect a similar kind of a returns or a journey from public assets? The question is always, sort of doubtful. So, that's one reason why there's so much of importance for the private capital space, which is the multiple on the invested capital is really very large. And it's like how it happens in public market spaces. It's similar. The story is really very similar in private capital as well, which is the top tier share or the top funds would end up controlling the majority chunk of it. And our job as, let's say, as an employee or as a member in practice, our job is to figure out of where we can sort of really tap, and that's what the entire talk is going to be all about. Yeah, it did move. All right. So like I said, we're going to move, sort of, go on a journey, which is the journey is called follow the money. So I'm going to take you through 4 stations. So station 1 is the source, which is where the capital comes from. So like I said, there's a specific lingo. So the investors here are called LPs or limited partners. There are a lot of sources, which is what we're going to see in detail, probably, let's say, region wise or source wise. How do you structure it? Which is once you have gathered capital or once you have the commitment of capital, how do you structure it? Which is where do you set up your entity? So, we're going to mainly talk about Cayman, Luxembourg, Singapore, and GIFT City here in India. And station 3 and 4, this is where my experience, this is where my background sort of kicks in, which is you deploy and you exit. So, my experience, let's say on the investment banking side or advising, sort of these transactions, it's mostly revolving around the deployment and the exit part of it. So once you have gathered the money, once you have all your structuring, layering everything in place, which is, obviously you want to minimize your tax impact for it. And how do you deploy it, which is where do you invest? And Indian companies outside India, and what are the major factors or what are the major valuation levers that you look forward to? And do you buy out an existing company, or you just go into public market space and you just start by buying shares, or you do a sort of a fund of fund structure and exit? So we have sort of few exercises or few case studies after each station, so that somebody who's really interested in, they are able to get the entire picture and they're able to sort of execute it through the case studies or through those problem statements. So at every station we end up asking the same question, which is this a job for an Indian CA or a fee paying structure for us, for members in practice? And there are, like I said, there are live exercises or case studies which will help us test these ideas and really sort of gather that kind of confidence to really go out there and seek opportunities for us. Yeah. So station 1, which is source, which is before fund buys anything, it has to raise something, which is it has to raise capital, it has to raise money. So who actually hands over the money? That's the idea, and that's how I have divided the entire station into different types of investors. I'm sticking with a very common lingo so that we don't really get carried away by it. But like I said, this space has a different lingo altogether, and the reason they do it is essentially they want to separate themselves from the public markets. And there's always a sort of a deemed tussle or a fight which goes on between public market fund managers versus private market fund managers versus investment banking fellows versus private equity fellows versus venture capital guys versus early seed stage guys. And of course, over and above everything, there lies this one arm called consulting. So there's always that some kind of a deemed fight which goes on. And they just want to differentiate, and that's why a separate term. So LPs, limited partners, somebody who has a limited liability, like an investor. So public pensions, these are one of the largest asset managers out there. Uh, Sorry, wrong language. Largest investors out there. Now, when I say largest, it's not only in terms of capital, but it's also in terms of the risk appetite. So, these are typically pension funds or teachers' endowment funds, etc. Now, their time horizon is more than 10 years. Now, when I say more than 10 years, so all your temporary Trump economics, or your Iran war, or what's happening with Putin, what's happening with China plus one strategy, what's happening with India setting up its military base in Andaman Nicobar over a period of 10 years or more than 10 years, all these stories would eventually sort of flatten out, and you would see a very sort of a clear picture of what really happened between, let's say, 2025 to 2027 for that matter, right? So from a risk assessment point of view, these are probably the best investors to work with, but obviously hardest to sort of gather because because of the size and because of their sort of geographical presence, which is mostly in the US and Canada. They're the ones which have the largest assets under management share. But the risk perspective, they are the best ones. So that's another. Now, from Indian perspective, I'm going to jump to the third one first, which is the insurers. Now, we've all seen LIC, being very aggressive over the last 5-6 years on the Indian public equity market space as well. So again, they do have a lot of constraints in terms of what sectors, how much sector limit, and how much stock limit that they can sort of ideally invest into. But over and above everything, they are really good investors, or sort of good asset managers to I'm talking in terms of the size of assets. I'm talking in terms of the risk assessment or their risk appetite per se, right? Which is really large, which is more than 5 years, sometimes even more than 10 years, right? Now the second one, which is the sovereign wealth funds, they are the ones which are really very aggressive, and they're mostly from the Gulf territory. The GIC, Temasek are sort of sort of an exceptions to it, which is they are based out of Singapore. Now, I have two stories for it to really understand, because the title is, follow the money. It's really important to understand where does this money essentially came from. So, the Abu Dhabi Investment Authority, or Mubatala, or PIF, or for that matter, GIC, or even Temasek for that matter, uh, all these funds essentially depend on the dollar revenues, which these countries end up generating. For example, Singapore acts as one of the uh, the largest ports access to Southeast Asia. So, and Singapore and Malaysia, when they sort of when they got independence from the British, Malaysia took
I think we lost Sriharsha sir. It's a technical glitch. I will get back soon.
Just a moment.
So meanwhile, the sir rejoins us. I think traditionally chartered accountants have been associated with accounting, taxation, audit, and compliance. However, the business landscape is changing rapidly. Today, business, particularly startups and high growth enterprises, require more than just compliance support. They need strategic advisors who can help them raise capital, improve governance, evaluate investments, manage risk, and create sustainable value. This is where the private equity and venture capital ecosystem presents a tremendous opportunities to chartered accountants. This is at every stage of investment life cycle, CAs have a significant role to play, whether it is a financial due diligence, valuation structuring of transactions, tax planning, financial modeling, regulatory compliance, fund accounting, portfolio monitoring, or assisting companies in becoming investment ready. The expertise of chartered accountants is highly valued. India is witnessing unprecedented growth in entrepreneurship, innovation, and startup activities, as you all know. As capital flows into these business through venture capital and private equity funds, the demands for finance professionals who understand both numbers and business strategy continues to increase. I think Harsar is back. Sir, over to you.
Yeah. So sorry for that. One second, I'm just fixing my background as well. No, this is the other one. All right. So sorry for that. And perfect. Sorry, I think I was at Malaysia and Singapore. So yeah, Malaysia decided we want nothing to do with the capital from the West, and decided to be a very aloof territory. And Singapore thought, we are on our own, and we'll just go back to people who ruled us for more than 70, 80 years. So they went back to the West, and that's how Singapore became so really vibrant. And like I said, when we say follow the money, it evolves around the entire journey from how it really sort of the entire storyline of where it ideally begins. And I'm guessing, Trump has made this really very clear that he is interested only in oil for that matter, and all the revenues which the Gulf have been generating is through petrodollar arrangements. So when I say petrodollar, meaning let's say Abu Dhabi ends up selling oil to the US or anywhere across the globe, it has to take revenues in US dollars, and that's how dollar became so dominant across the globe. And with that petrodollar arrangement, what let's say the Gulf ends up getting in return is a military power, right? So Iran didn't sort of bulge. Saudi, Qatar, Oman, UAE, they all sort of gave in to this kind of deal. So now imagine you are a Gulf country, let's say you are UAE, and you have insane amount of oil reserves. But now you also have insane amount of dollar reserves, US dollar reserves. Now, what do you do with this US dollars? Now, you hire consultants. Let's say you hire McKinsey for that matter. You advise McKinsey in terms of, we have, let's say, more than $4 trillion of US dollar, which we can't use in our country. We want to sort of invest. Where do you do that? Now, they're not going to advise saying that, you go and invest in, let's say, HDFC Bank shares or Reliance Industry shares because they are just doing great, because it's a long-term capital which they want to really and slowly deploy. And also the thing with the private capital LPs or investors they are really looking to add that value to the story. So, as Indian CAs, if we are, let's say, looking for members in practice, it's not only returns or multiples which they look for, but the kind of value creation that they're able to bring along the stage. For example, let's say they would end up investing in a city, let's say in Africa, which they are end-to-end part of the entire, the growth story for that city, right? So that's the kind of value creation which they eventually sort of look forward to, and that's why they would choose to park their capital on private side and not on the public market spaces, right? So because these are Gulf countries, they want to diversify away from these oil investments. So they, let's say, they hire McKinsey and Co for this kind of arrangement. And what they end up advising is, you invest in startups, tech startups, AI startups. And what's the home for these startups? The answer is Silicon Valley, which is based in US. So US has created the entire arrangement of, they will receive oil for dollars, which they are going to eventually receive back through invested capital from the same countries which they fetch oil in the first place. So that's how smart they play. But anyways, that's one leg of it. And endowment funds or foundation, which is typically university endowments, and these are really large. So these are billion-dollar fund sizes. So they follow something called as a Yale model, which is they're really very heavy in terms of alternative investments. So Yale, that's an US based an Ivy League university, and Yale model, because they are the first ones to really start with investment on the alternative investment side. So when I say alternative investments, it does not really mean real estate, not only real estate, but gold or hedge funds or a fund of funds. That's what alternatives really stand for here. Now, family offices and HNIs, they, like I said, they're becoming really uh, very kind of growth oriented, especially over the last 4 years. That's what we're seeing here. And anybody who has that's the kind of numbers which ideally come to us, which is any family office with more than 10-15 crores of assets under management, or thinking of deploying that kind of money, would ideally think of starting their own family office, and they would kind of diversify into a lot more areas than just on the public market spaces. And retail, like I said, PP Fast was uh, I can't say the first one was, but was is at least is the latest one to start an alternative fund for retails. So I mean, this is where Indian retail players are really kind of really very excited to be a part of the so-called private capital space. And then I'm sure you must have seen traction amongst your young investors as well, which is, I'm not saying investment in Bitcoin, but investment on unlisted market spaces, right? So let's say HDB Financial or Reliance Retail for that matter, or Nayara Energy for that matter. So on the retail NSE, of course, how can I forget that? So on the retail unlisted market space, this is just one area which is just booming up in front, and the kind of the spreads that we end up getting as as bankers, or as agents or as consultants, it's really very large. Sorry, the PPT is here. Yeah. Now, yeah. So domestic capital is rising for the first time. Indian institutions and family offices are anchoring large funds. Like I said, it's really up and growing. Retail is being let in, and the private credit is exploding. Now, this is not really the case in US right now, especially over the last 6 or 8 months, where private credit is seeing some kind of a stress, especially on the US and the European side, on the Western European side. But on the Indian front, private credit has always been booming. Now, this is just my 2 cents on people who are looking, or members who are looking for advising, let's say, these private equity giants, or members who want to get employed by these private equity giants. Um, Now, if look at, let's say, probably KKR, that's one of the largest private equity funds out there. And if you're really looking forward to, let's say, you just somebody from, let's say, FP&A working in corporate finance in, let's say, HUL for that matter, you want to jump to KKR on, let's say, deal sourcing, or on the investment analyst, or as an investment analyst, or just a member in practice, and the kind of deals which KKR ends up doing, which are all more than 8 or 9 digits per minimum. So you're thinking that maybe if I could get just, let's say, a very tad bit compliance with that FATCA compliance kind of work, I might end up charging, let's say, for a normal private limited company, I end up charging, let's say, 25,000 rupees. For KKR, I can charge easily 3 to 4 lakh rupees of fees, right? But there's an easier way to get access to these giants. So, like I said, there's a difference between the committed capital and the deployed capital. So committed capital, so typically every fund would have very large dry powder or that kind of armory setup, which in case if they see an opportunity, they would invest. But there is no time commitment to it, which is, they would deploy those funds in the next 1 year or even 10 years for that matter. So they would keep that kind of capital aside for now. So what do you do if you are, let's say, KKR for that matter? You have, let's say, $1 billion of dry powder ready. What do you do with that? You can't really park into fixed deposit. You can't really go and invest in, let's say, government bond and get some 6.5, 7% yield, right? Which is again taxable. So, what do you do with that kind of dry powder? Which is you set up an NBFC and you give out loans to companies who are in need. So you don't give out equity, but you give out debt, which is private credit part of it. And typically private credit would end up charging somewhere in the vicinity of 16 to 22% rate of interest per annum. So if you're earning 16% per annum on your dry powder, which is, which is not really deployed as such, and you're still getting about 16% per annum. So what's the bad deal in that, right? Now, getting access to that NBFC is much more easier than getting access to the private equity part of things. So it's the same umbrella of KKR, but they set up a separate, let's say, KKR India Finance Private Limited as an NBFC, and that's how the entire sourcing, and that's how the entire the manpower is on the NBFC part and not so much on the private equity part. So that's one area which sort of we can target really very easy. Now, there's a story behind, one very famous case on CG Power. So, if I remember the exact year correctly, I think this was Q3 of 2019, if I'm not wrong, or Q4 of 2019. Sorry, FY20, which is I think Jan 2020, or this must be March 2020. I think it must be Jan 2020 if I'm not wrong. But anyways, that's not the point. KKR had invested in this company called CG Power, which was a listed very old, earlier also known as Crompton Greaves, and they had invested some 60,000 crores of the fund in CG Power. Now, this entire group was owned by Thapar Group and family. So they were really very long, and they charge, I think, 16 or 18% rate of interest on the credit, which they ended up giving to CG Power. Now, for the first 12 months or 18 months, there was no problem whatsoever. And I think it was Q3 of Jan 2020, if I remember the entire timeline correctly. Um CG Power went for a board meeting. Now, typically, every board meeting would last an hour, hour and a half, 2 hours max. So they started the board meeting at 3 p.m. in the afternoon, and they wrapped up the board meeting 7 a.m. in the morning next day. And the public disclosure which they end up coming out, which is that all our assets are bad. We are sort of declaring bankruptcy, and there is nothing that we can do about it. So KKR essentially, and I mean, we understand, credit risk per se. So whenever a company declares itself as a bankrupt, or, it goes through that default category of rating, any lender who's given, money to this company would have to ensure that they're classifying their assets as a non-performing asset, which is essentially take a hit on your P&L for the amount of loans given to CG Power and Co. So KKR had to take 60,000 crore rupee hit on their P&L for that quarter. And, at that point of time, I was following this story really very closely, not because I had invested in CG Power, but I was interested on the part of deal sourcing through KKR. But I remember that, this was a gone case. You've just because of that, that greed of 18%, you have, lost almost 60,000 crore worth of rupees. Now, I'm not really sure what happened after that door. I have to read much more on it. But if you look at the share price of CG Power today, it's crossed somewhere 900 rupees. And the lows was somewhere in Feb or March 2020, which was, I think, 4 rupees or 5 rupees or so. So it has that kind of a perfect run from a 4 rupee share to a 900 rupee share for CG Power. And I'm guessing that's why KKR had sort of seen through this entire journey, and that's how they had sort of invested, through credit, and then probably they got equity a lot more cheaper. So there's a book by Natarajan Srinivasan called, I think it's called The Great Revival. It's the story of CG Power bringing it back to senses from the stage of bankruptcy. So, like I said, I haven't read the book yet, but that's still lying in my wardrobe, planning for me to read. But that's one story which, private credit, that was just an outstanding case. So somewhere in 2020, I had no sense, why did this really happen, or how can they make, such a bad bet. But then now, after 4 years, or after 6 years for that matter, you get the entire complete picture, and that's the kind of long-term play which these guys play. So if you're an equity investor or a public market investor, you know what, your horizon is only going to be a week or a day or a year for that matter max, right? So that's the idea, and that's like I said, there was one kind of a 2 cents from my end, which is if you're targeting private equity, you might want to target the NBFC part of it rather than just on the larger show business part of private equity. All right. Now at the sourcing stage, what kind of work do we have as an employer versus in practice? So I think I've added this along my presentation as well, which is as an employee you would focus, let's say, on the limited partner side, on fund of analyst or an investment analyst, which is you'll be mainly screening and selecting managers. So let's say if you're ADIA, you really want to invest in Africa, where do you start? That's the kind of question that you would answer at this stage. Operational due diligence reviewer at a pension or a sovereign wealth fund, investor relations and onboarding analyst inside a general partner. So general partner is the one who's going to actually manage that money for you, right? And somebody who's in practice, you start with operational and financial due diligence on the general partners for your investors, onboarding process, the compliance, KYC, FATCA, CRS, classification, tax residency. We're only talking about the sourcing stage for now. We'll come to the structuring part right after this. And family office advisory, typically on the Indian private wealth. So there are two entities which I want you to look up to. One is called 361 Asset Management, and the second is called Nuvama Wealth. Now, Nuvama was erstwhile, Edelweiss, and 361 was erstwhile IIFL Wealth. Now, these both have sort of spun out from their own parent companies, and the kind of clients, the kind of assets under management, the kind of work that they end up doing, including the compliance part, including setting up family offices, including advising LPs on hiring a general partner. They are doing the exact same thing which what this entire discussion is all about. So two companies, if you're just able to go through their website or go through their financials or just meet somebody and just understand how 361 Wealth Management and Nuvama Wealth Management work, you will get a very clear picture in terms of how does the global capital structuring or sourcing really work. Sorry. All right. Now where the money is pooled. Now this is where I uh, I'm expecting that you have the audience or the members in practice will have a lot more or a higher edge than me, which is like I said, we're going to talk about Cayman, Luxembourg, or Delaware, Singapore, and Gift City. This is the densest kind of work for us for us as in members in practice. Now this is where you have very limited kind of work if you are an employee working for let's say a private equity or a venture capital for that matter, right? All right. Now I have added Delaware. Now there have been a lot of back and forth, especially on the state of Delaware. So Delaware is a state in the US which offers kind of a tax neutral. So a lot of the largest Fortune 500 companies have their registered offices in Delaware to just ensure that the tax impact is sort of minimum. Like I said, there has been a lot of back and forth after I think a Delaware court's ruling which acted against, I'm not sure, some tech company. I think it was, I don't want to take second guesses, but there has been a ruling by Delaware court which was against ease of doing business. A lot of companies are moving or shifting base from the state of Delaware to Texas to Nevada to some extent, and a bit towards Utah as well. So the way US operates is every state has its own different tax structure, and it's a free capitalist kind of economy. So any state who wants to compete, wants to gather more capital, would just go out there, make amendments to which let's say tax structures, ensure that the courts are or are sort of in that same kind of mindset as well, and that's how it happens. So Texas is now in sort of fetching a lot more deals than Delaware, or structuring deals than Delaware. And I mean, this is really like a menu card, right? So if you are a fund, or let's say if you are a limited partner and you're really looking forward to to set up a structure, now this is your menu card. You have to sort of pick and choose. Now, good thing about Delaware or Texas or Cayman Islands is, you get access to that uh, US capital really very easy, and it's really very flexible and really very fast to open, accounts there. Um, I don't know if there are any young members out there, but there is a Netflix documentary. I don't know if it's called a documentary or a movie, but I think I'll remember the name in a bit, which revolves around, the case for Panama Papers. It's called Laundromat. It has Meryl Streep, Gary Oldman as very star-studded actors, and the Laundromat. That's I think the name of this movie or documentary, which tells you like a step by step of how do you structure these kind of funds. Luxembourg, Ireland, this gives you that EU passport. So if you are a family office or if you are an investor, an HNI investor, if you just set up your office in Luxembourg or Cyprus or Ireland for the matter, you get that access to EU passport, which is, you get to travel visa free for more than 12, 15, 18 countries or so. Singapore is, was and is always somebody who wants access to Asia and get Chinese capital and get some kind of Japanese capital alongside. So Singapore is really a very, kind of a looked after structuring country. And we have somebody homegrown on our own soil, which is Gift City. So, we are going to talk a little bit more on Gift City as well, and in terms of uh, how this is India's answer to to changing world order, but also it's a very really old concept here in India. So Gift City has been in existence for more than 10 years, but the regulator, which is the unified regulator of the IFSCA, which is the International Financial Service Center Authority, just got set up in 2021, if I'm not wrong. And they're working. So this one unified regulator, when I say unified, this is, I think, so far the world's only unified regulator so far, which has vested powers of SEBI, of RBI, of IRDAI, of PFRDA. Who am I missing? Yeah. So these four vested powers is with the IFSCA, or the Gift City regulator. Now, this is sort of unheard of. So, you don't really have to go place to place seeking approvals or, doing your compliance. You just have one authority, one kind of compliance task. I mean, the reality is a little bit different than this, but, the overall layering and the structuring part of it is really simple at Gift City. And of course, much more cheaper than Singapore, Mauritius, or Luxembourg or Ireland, for that matter, even Cyprus. Right. Yeah. So before I sell you, the concept of Gift City, let me be fair to its rivals, which is because most of the world capital still pools in, these three, or majorly these three, which is, Luxembourg, Ireland, Singapore, and the US. So Cayman, Delaware, or Texas are the global default, tax neutral, fast, familiar to every US investor. Though even Cayman Islands now lives in that economic substance rule, and a lot of backlashes under the OECD or under the BEPS rules. Luxembourg and Ireland are sort of the gateway to European money, and that money is, I mean, surprisingly, is coming out really very slow over the last 18 months or 24 months now. And especially the last 12 months, you're seeing European capital really being deployed. And, they're really striving for that innovation or that kind of, they're on that sort of growth mindset. That's the idea. Uh, so Luxembourg, Ireland became your EU passport, and Singapore is, a direct competition Gift City. But the way the Monetary Authority of Singapore operates is not really like a regulator, but like a startup enthusiast. So when I say startup enthusiast, they really want to go out there and experiment whatever that they can, and they don't really care about the repercussions, because they understand that Singapore is going to be, like a testing ground for a lot of these large fintech companies or these funds or these banks to really come out here and do something about it. So, for example, let's say JP Morgan Chase had come up with their own, like a token money called USD, JP Morgan dollar, JPMD, and they really wanted to test in real world. So if you try that in India, JP Morgan knows they have to go through a series of, recommendations, compliance, a lot of back and forth, but they went through Monetary Authority of Singapore, MAS, and they just opened the door and they said, "Oh, okay, you just tried with us." So JPMD did its very first transaction with the Monetary Authority of Singapore, which is the regulator of, of probably one of the countries with the largest per capita income. So that's, they are sort of operating at a very different playground out there. And yeah, that's uh, the kind of fair bit. Now, I've titled it as, from Mauritius to Gift City. Now, why does all this restructuring or the structuring part of it even exist? Now, this the foremost to it because it's, story of our own sort of market kind of growing up. So the first point is, the first move is for 2 decades, money came into India through Mauritius and Singapore using tax treaties to avoid capital gains tax. It was efficient and increasingly, it looked like a treaty shopping. And I think it was 2016 or 2017 when the GAR rules came in, which is the General Anti-Avoidance Rules. And the older arbitrage sort of flickered. And the third point is, rather than just close the door, India built its own room, which is the Gift City. From 2020 or 2021, when the IFSCA sort of came into being and Gift City ideally emerged, an offshore hub where funds can raise dollars, not dollars only, but non-rupee currency and invest globally without, GST compliance, without paying any tax on it, and with incentives to keep everything onshore here in India, right? And we are now in that so-called post-BEPS world where jurisdictions no longer compete on secrecy or like a clever treaty, but they really work on substance, which is real people, real governance, real reporting, and you have to be physically present. So, Gift City has been trying really hard uh, to ensure that physical presence is there. So they have a rule that minimum 2 employees should be there on ground, which is a principal officer and a compliance officer, or a PO and a CO. And yeah, so that substance word has sort of really evolved across these sort of jurisdictions. So everybody thought that Panama or Cayman are the safest bet, but then it was just about time when the kind of leakages happen when they happen, and it's just, I think it's a lot more opportune time for us as an employee, as a member in practice, that we are living under that. We are seeing that the initial stage of growth for the Gift City, right? Now, I'm guessing we understand how Gift City operates, which is, it's a earmarked territory which does not have to comply with the FEMA rules. It's like a non-resident land where any transaction in non-rupee does not invite any kind of Indian compliance or tax or GST payment whatsoever. That's It's a piece of Indian soil treated for financial purposes as a foreign jurisdiction with one unified regulator, which is the IFSCA. A fund can pool money in, let's say, US dollars from residents, non-residents alike, and invest in India or anywhere in the world. But we are not seeing so much movement of capital happening from residents of India because you have an RBI scheme called LRS, which is liberalized remittance schemes, and you can invest, up to 250,000 US dollars each year. So the limit is so high that, and the compliance is bare minimum. You just have to go and check that box in your net banking that you understand LRS and you've read all the terms and conditions, and you just have to give disclosure for the past LRS that you've done for the current financial year. That's it. Your job is done. So, and the broad limit under LRS is so huge that residents don't really feel like moving, setting up a separate account, a broker account or an investment account with an entity here in Gift City. So that's where we are seeing, still kind of a buffer before this actually boils down into. And I mean, with the clever part about the gift cities or the ISCA's regulatory design is, they don't license each fund, it licenses the manager, which is, the general partner. So it licenses what we call it as a fund management entity, the FME. So one registration, you set up the manager of the fund management entity, and all the schemes there forward will just be sort of compliant. Of course, you have to do an annual compliance. That's a different story altogether. But registration per se, it's just one that you need to do. And the numbers on the right, I lost my screen here. Yeah. So there are about 194 fund management entities set up in Gift City, more than 310 schemes or the funds are operating, and you just have one regulator overseeing the entire thing. This is just a bit background on the Gift City, which is you divide yourself into authorized FME, basis the kind of minimum net worth that you have, a registered FME, which is non-retail, you have net worth of $1,000, and a registered FME, which is retail, you want to focus on the retail part of it. So you should have a net worth of minimum of $1 million US, right? So yeah, and why a fund chooses Gift City, a tax holiday. So it's not 10-year tax holiday, it's 20 years. So this was prepared before this budget came in. So 20-year tax holiday, for a 25 consecutive years, you can choose what 20 years that you want to take holiday from. You don't end up paying any GST. You don't end up doing any kind of major Indian-based compliance work. Of course, unless until you are a bank. So then Gift City has sort of a dual regulation that, part of it you do it with RBI, part of it you do it with us. So that's another, pain point. But I don't see it as a pain point. I see it like a flow of work that sort of comes into our plate, right? So which is, and if you haven't been to Gift City, I must take this moment and acknowledge the kind of work which Global Trade and Services Committee are doing here at ICAI. And I think it was just last month, early last month, if I'm not wrong. I think, yes, it was almost the last month, 7th or 8th of May, when they organized a Gift City tour for 2 days. And I mean, if you haven't been to Gift City yet, if you can, at least on a individual capacity or through these kind of forums, I think you should. It's just one area which at least is going to just I mean, sweep you you know sort of in and out. And I mean, the kind of growth that we've seen in Gift City, especially over the last 3 years, after 2023 per se, it's just insane. So there were only the first time when I'd been to Gift City was somewhere in August of 2023, and under the the IFSC region, they only had only 3 corporate offices, and now there are more than 9 or 10 operating right now, and 20 more are under construction. And on the DTA side, the domestic tariff area side, I mean, there were, I think, only 4 buildings or corporate offices out there, and now there are more than 35 corporate offices out there. And they're all occupied, they're all up and running. So it's just one ecosystem, which I think as a CA, be it, I mean, it doesn't really matter if you're in, you're under service or you're under a sort of practice, but this is just one ecosystem which you cannot really kind of miss. So it's kind of a request that if you can, whenever that you can, through forums or through just individual capacity, this is just one ecosystem which we can't really ignore. I'm really being kind of that blunt. Yeah. So this is one exercise for you at the end of 2 stations, which is sourcing and structuring. And I think you know the answer for it any which ways, because I've been really very blunt about it. But anyways, so let's read the brief. So a US-based GP or a fund manager is raising $400 million fund. Capital comes from a Gulf sovereign wealth fund and US pensions. 70% will be deployed into Indian growth stage companies, the rest across Southeast Asia. The GP wants tax neutrality, a credible regulator, and some kind of an India proximity. So what do you choose? Cayman, Singapore, GIFT City. I'll give you a moment. There is technically no correct answer for it. You know, there are a lot more constraints which you will really face before answering these questions, and you will probably want to understand before answering this question. But given what we have here, you want an India proximity, you want a credible regulator, which is IFSCA, and you want some kind of a tax neutrality. So GIFT City, that's the option. But like I said, there's no single right answer. This is just to get everything that we've spoken about into like one common base point, right? Yeah. So structuring opportunities for us, let's say as an employee, so fund accounting, financial controller inside these funds or fund management entities, that's one. Compliance risk officer at GIFT City. I mean, this is just insane. So I was at the round table at GIFT City, just last month, like I said, organized with the same committee of global trade and services, and we had this one member working at GIFT City, and he runs this job portal for the benefit of all the professionals at GIFT City. So it's not only CS specific, but everybody across the board. And I was somehow surprised to know that even I was part of the same group that he was sort of talking about, and the kind of jobs that come into GIFT City every single day. I mean, I've never seen it probably even in a city like Mumbai. So this is just one area which, if you are an employee, I mean, it's the sky is the limit, and literally sky is the limit. So that's one area which I would, at least you go out there and explore for yourself, right? That's the point. And fund operations, or your NAV calculations, or the entire compliance to get to that NAV, and investor reporting in a GCC or GIFT City, or anywhere where the fund is operating. For members in practice, everything from setting up, let's say, a fund management entity or a fund inside GIFT City or anywhere else that you're sort of planning into. So structuring, substance net worth certificate, KMP, appointing of those KMPs and their compliance, the new IFSCA mandatory certification, which is you have to, I think September is the deadline, or August is the deadline for getting that certification done for every fund management entity. And ICI, along with the same committee, is working tirelessly to ensure that CA members are getting that kind of upper hand for this IFSCA mandatory certification. And there's some kind of an ongoing fund management administration or NAV computation, or just broad independent valuation. This is where you'll find a very recurring kind of a work flowing in. So this is where India's CA pipeline meets India's own offshore hub, which is the 2025 rules for the fund management rules of IFSCA don't just permit CAs in places sort of they require them. So build the GIFT City competence now. All right, now we move to the next station, which is okay. I will come to the questions in a bit, which is where the money is invested. Now, the entire the deal stories through the life cycle part of it. So you've sourced your capital, you've structured it, you've ensured that wherever that we end up deploying from here is going to be tax efficient for us, and how or where do you sort of start. Now, this is just a broad India capital landscape. Now, what I want you to focus on is on the very right-hand side, the first minus 17% block. It says total fell to $36 billion in 2025, which is almost almost a 17% fall. And the traditional PE dropped to 19.6, which the earlier average PE check was about $209 million, which now stands at $118 million. So that's a 33% fall. But what has really happened is the next block of it, which is the venture capital and the early stage growth funds have stepped in, and that assets under management has grown up 18%. So investors typically wrote more number of checks, but smaller checks. So there are more transactions happening at the mid market and let's say early stage markets, and it's really good for us as members in practice or members, let's say, planning or trying to get employed by these kind of funds. The reason why I say it, let's say if there were only 3 deals happening, but then the overall broad economic number was, it's up 50% from last year. But then there were only 3 transactions, and all 3 were done at the top end kind of level. So what's in it for us? Somebody who's starting out, somebody who's trying to, sort of understand the space. Now, why this is good for us is there are more mandates. Now there are more transactions happening alongside. And just, if we are able to get, let's say, even a tad bit part of that entire deal, we will, we can say that we have arrived, right? That's the idea. So no, this is really a very convincing story for us that there are, more number of checks written. Though smaller, doesn't really matter, because what we are interested in the number of mandates and not the size of mandates. Because the size of mandate is really large, the top share is going to just go out there and acquire, and we'll have sort of not even crumbs for us to eat upon, right? So that's really a very convincing story for us. And India's share of Asia Pacific PVC held broadly stable, which is almost a 20% growth year on year, right? So that's really a good convincing story for us. Now, where the money went and how India diverged from the world. So, where have they really parked their investments? So, consumer retail, manufacturing, industrials, financial service, healthcare, and infrastructure. So that's sorry, that's broadly where the power play happened. Now, consumer retail is really riding the entire growth story right now. So it's not only Zomato or Swiggy or Zepto for that matter, but it's the entire supply chain ecosystem which India is really very strong, trying to be strong at. And manufacturing industry is just, when we've been playing this China plus one strategy, I think since 2021 or 22, I think it was 2021. That's when the term China plus one really, sort of emerged, and we've been playing that story ever since. So it doesn't matter that we are now friends with China or we're trying to be friends with China, but the narrative has always been that we strengthen our manufacturing, and it makes sense for us because we have that very large young population, and manufacturing is where we can really bring that employability numbers back. And real estate infrastructure, we are not seeing so much on the private market or the private capital side, but it has already aged so much for these investors that they are now sort of looking for exits, and they have been looking for exits for quite some time now. So no fresh deals or capital flowing to real estate infrastructure. I mean, not so much. You may argue that you're seeing Adani going left, right, and center on infrastructure or on real estate, but that's not private capital. That's the point which I'm trying to make here. That's that's public market space. So you don't see KKR investing in a property in Alibag, for that matter, or you don't see Blackstone coming up and saying that I'm going to invest in a land in Gift City. That's that's all done and dusted a long time back. The numbers, yeah. So the last point on the right hand side, which is India's repricing and not derating, and the long structural story is still kind of intact, right? So like I said, this is where you really look forward to deployment kind of stage. And if you are a general manager or a general partner or a fund manager, you want to look at the broad narrative, economy wise and sector wise, before you can actually advise your LPs, or you can make a call for yourself of where do you want to kind of invest. Yeah. Now this is really very interesting case study, which is Chris Capital. It's an homegrown Indian private equity giant. Launched a fund called Fund 10 or Fund X. So it's ideally Fund 10, and this was the largest India-focused sector-agnostic private equity capital ever raised in this country, which is $2.2 billion. This just happened last year, 2025. Now, 2025, when, India was going through, a lot sluggish bond markets and equity markets, despite that, they were able to raise the largest capital here. And 85%, of course, was international, 15% was through domestic investors, institutional investors like mutual funds and family offices. 15 to 16 planned investments, which they have deployed so far, ticket size of about $75 to $200 million each, typically in healthcare, financial service, pharma, and manufacturing. So 15, 16 deals, even if you take an average ticket size of 100, so they've already deployed 1.6 bare minimum. So 50% of it, more than 50% of it has already been deployed, right? So, I mean, you don't see that numbers play out so fast in developed markets like, let's say, Western Europe or UK, or for that matter, even US. 3x, that's the returns from prior exits, which they have, proven alongside, and that's how they were able to raise such large money here in India within just a record time of only 6 months. So what are their sources? So, I mean, we're just dividing the entire transaction or this entire case study into our 4 stations. The source, so you had a lot of Gulf-based sovereign wealth funds, including ADIA. You had Japanese investment pension funds. You have Indian family offices. So all the LP list that we've seen at the very start, everything sort of gets covered here. Structure. So a fund vehicle, a fee-paying model was sort of created for a fund management entity. And how do they deploy? So they have deployed 15, 16 checks, $75 to $200 million each, which needs FDD, transaction due diligence, and valuation part of it. And exit, so they've done some 80 prior exits. So, each will have a separate tax impact, tax computations, a lot of waterfall events. I'll come to the waterfall part of it. So the idea is a CA would end up touching every part of the transaction from sourcing till the exit. Yeah. Now, what's in it for us on the deployment part of things? So as an employee, so there's going to be, you are an investment or a portfolio analyst for these early stage growth funds or for a P giant. There's going to be a lot of financial due diligence. Typically somebody with a big 4 transaction service or transaction advisory services is going to really help in this. And portfolio monitoring, value creation, tracking your covenants, your key performance indicators, and everything. And for people in practice, you will be assigned as independent, due diligence authorities. A lot of independent valuations that you'll have to do for, ensuring that you are creating that entire life cycle plan for it with the planning and exit, let's say after 5 years or 10 years down the line. So entry point, exit point, what multiples do you want to bind? So everything from scratch is what you will have to work. I've said deal structuring here, but I mean, ODI, OPI, FEMA compliance, and everything. But there is even a part on the on practice. I mean, that's how I got entry into investment banking in the first place, which is you even want to focus on deal sourcing, which is where transactions are happening. If you get a sense, you have a very large private limited company who is, let's say, manufacturing. I mean, I'll rather give an example. Let's say you have a client who's a 250 crore annual revenue. Let's say rubber manufacturing company, right? It's registered as a private limited company, so you don't really have to worry about whether it'll get funding or whether it will get acquired or not. And you've come to know, let's say through a banker or through a friend, or you just keep your ears and eyes open. You've come to know that, let's say Chris Capital started its fund 10 and they want to invest, on the manufacturing part of things and rubber or chemicals is one area which really sees very easy exits and very easy entries. So probably this is a easy game for them that they deploy, they end up paying, let's say, 1.2 times their net EBITDA. For that matter, last 3 years average EBITDA, the multiple that they end up paying, and they are able to easily exit after 2 years or 3 years of time, without having to go through those IPO or those secondary sale kind of mandates, right? Now, he's your client. You just have to convince that client that we have sourced deal, let's say through Chris Capital, and I mean, typically these transactions would ideally work. I mean, this is how we do it, which is, it's going to be a family structure or a family business kind of a structure. And let's say there are two brothers, both age 75 now, and they have, let's say, 4 children all together, and they're not really interested in this kind of business. But of course, they would be interested in the money which they end up getting by selling this business, for that matter. So, these kind of overviews or these kind of narratives has really worked out really well for us, because it's a mid market or like a lower mid market kind of space, and you just have to convince your client, which is two brothers 75 years of age, that your kids don't really want to continue the business. We have sourced a deal, and I mean, uh, I can't really tell you precisely of how do you pitch and everything. At least this is not the right forum for it. But what you can do is, probably get few licenses for, let's say, I think ICI gives us some kind of a concession for, there's this, software, I can't say software, but a database called Pro42, or you end up getting those free licenses from Traction or from VCC Circle, or if you probably, working at a large company, you probably have access to pitch books. So what you can do is, probably assign one member from your team to just ensure that they understand your own clientels, start till the end, right? So who are all family businesses, who are all sort of aged or sort of looking for retirement plans, or looking for sell-off plans, or looking to acquire sort of other vertically, horizontally, in that fashion. And just assign one team member or one, probably even article, a couple of articles can sort of do this job for us. So just have to just go out there and just gather everything and make it into a very neat kind of a mind map, so that that whenever a new mandate comes in, or whenever a new transaction comes in, or whenever you hear people around talking transactions or talking business, that okay, this is our perfect kind of fit, let's go and pitch, uh, and then it sort of works out really well. But before that, you will have to have that kind of mind map of, uh, for your own clientele broadly, or for, if you're an employee, for that matter, just pick up one sector and just ensure where uh, you know these kind of opportunities typically lie. Yeah. Now, where returns are realized. Now, I had an Excel working for it. I think I might jump onto that a bit. But anyways, now, there's a very typical structure which every, I think I missed it. No, I didn't. Called a 220 structure, which I think it comes in about, I think it comes somewhere, probably as an example. All right. So 220 fee structure is, you as as a fund manager, you end up charging 2% of the total assets under management. Now, there are clauses where it can be on the deployed capital, it can be on the uncalled capital as well, so total committed capital. But typically, large giants would ideally work on 2% of the entire committed capital. Because remember, if you remember still remember the case for the KKR, what they had done is, sorry. All right. So if you remember the case for the KKR, so what they had done is, uh, you know, they had set up, or they had kind of an offshore, uh, like an NBFC setup, like a private credit setup, and they still earn 16% rate of return on the uncommitted, sorry, on the not deployed capital as well. So that's how it typically happens for those large giants. But then again, it's always that difference of play which happens. The 2% is it on total committed or only on deployed capital, and 20% is what you will charge on the total profits or the total returns that you end up generating. Now there are different variations to it, which is 20% can either be on the total absolute returns or on net returns over and above hurdle rate. So that's the kind of value play which we have to sort of decide. But major exit routes are IPOs, secondary or sponsor to sponsor, just transfer from Chris Capital to, let's say, Blackstone for that matter, and strategic or trade sale, which is a corporate bar acquires the asset from the cleanest exit, which can ever happen. So, for example, let's say if you had a private limited company client, 250 crore annual revenue manufacturing rubber, and let's say Bata ends up buying that because this is a very easy horizontal integration for us. So what's better than it's actually put the entire business into a bigger kind of a use, right? So the promoter is happy, you are happy because you're getting a chunk of the entire transaction, and Bata is happy because they are able to create that value for themselves horizontally. So that's vertically. So that's why every banker or every advisor will look for the last bit of it. IPO is just going to take a lot of time, a lot of commitment, a lot of financial power, really ensure that it's really out there and you get the best exit possible. But of course, the multiples for an IPO are going to be typically higher than what we typically see on let's say typical strategic or trade sale. I'm saying $3.6 trillion. Again, this is all debatable numbers because how you compute the dry powder, that's what we discussed in the very first slide. That sort of really depends on it. But then, anyways, yeah, sorry, this was the slide which we're talking about. It's the 2 and 20 waterfall structure. So return of capital. So LPs get their invested capital back first. So limited partners would ensure that all the money that they've sort of initially invested, they would get the capital. Now, how long is it really going to take? That sort of depends on sort of company to company or fund to fund. I remember reading this. I think this was Mubadala, the Gulf-based sovereign wealth fund. Mubadala just came up with a mandate or a kind of a notification to its LPs that they have to further lock in their capital for 5 more years. So, take it this way. I'm taking from a different lens perspective for that matter. If you, let's say, are a family office, let's ignore family office. Let's say you are an HNI. You have a client who's an HNI, and he's really very keen on investing his money in private capital because he's seen some financial influencer suggesting that private capital is going to give him 3x kind of returns in span of 2 years, which is unheard of. So he really convinces you, that let's deploy this fund in some private capital space. Now, what really happens essentially is, in case if these kind of judgment calls are made by the GP, that you will not exit until 5 more years for that matter, you just, you're just blocking your entire capital and you can't really do anything about it. So it doesn't matter that you're getting instead of 3x or a 4x return, but the kind of liquidity aspect for it is just gone, right? So that's why you have to really sort of trade this. I'm talking from an investment perspective. From a practice or a job perspective, this is imagine this way: you're an employer, you're a like a compliance officer, or you're just doing the independent valuation for these kind of fund entities, and they end up saying that they're going to lock in 5 more years. So that's just 5 more years of kind of repetitive income for us, which is ideally great. And by the time exit happens, it's going to be a lot more work and a lot more checks coming through. But then that's not the point at all, right? So that's really great for us. There's something called as hurdle rate, which is a minimum preferred return which every LPs want to earn Typically, globally is about 8%, or you would peg to a risk-free rate. So over and above risk-free rate is where you as a general partner would end up getting that extra profit share. And GP's catch up, which is, you want to earn returns more than the typical hurdle rate, because that's where your 20% share would lie. So for example, let's say if a fund earns 9%, so the GP will earn an additional incentive of 9 minus 8, 1% times 20%. So it's only going to be 0.2% extra incentive is what is going to earn. Like I said, I have an Excel file to it. If we have time towards the end, I might just shift this entire discussion to an Excel with those actual number crunching, so that it's a lot more clear for us. And carried interest split, which is, you would typically divide whatever that's left, 80% into LPs, 20% into GPs. So that's the broad structure how it happens. So 2% management fee, 20% incentive fee, and hurdle rate. What else is missing? Yeah, clawback. So in case if uh, you know, uh, there are losses sort of very frequently, or there are losses very substantially, the LPs would might want to ask for these GPs to just give back a share of the profit which they had earned for not doing anything, or for just making a loss. So that kind of a clawback provision, which is returning back the incentive fee, is possible. And American versus European waterfall, which is so waterfall structures, I will need those numbers for that matter. So idea is that whenever there is a loss and there's a profit the year after that, you can charge an incentive fee only if the profits that you made are higher than the previous high for that matter. So for example, let's say year one, your total assets under management are 100. Year two, it falls down to 80. So there's not going to be any incentive fee that you're going to charge. And year three, it climbs the assets under management from 80 to 110. So on the differential of 110 to 80, you can't charge a 20% incentive fee, but you will have to charge an incentive fee from the previous high, which was 100. So differential of only 10. Because if this kind of clause doesn't happen, imagine this way, that every fund manager would just ensure that there is a like a staircase of returns. So 100 you go to 80, you don't charge anything. 80 you bring back to 100, you charge 20% fee for just bringing the investor back to his initial base capital. And then year three, again, you fall it back to 80, you bring it up to 100 for year four. So there is no actual real return materializing for an investor, but as a GP, you're still going to charge, that kind of return. So for that to not happen, this is where you have these waterfall structures. Yeah, now this is for you to really think upon, and come up with your answers. So on the left hand side, you have the transaction details, which is the fund has a committed capital of $200 million, fully drawn, management fee 2%, hurdle rate of 8%, carried interest, which like an incentive, which is 20%, and it's a whole fund waterfall structure, which is previous highs. And total proceeds returned at the time of exit is about $360 million. Now, how much capital is returned back to LPs first? What is the 8% preferred return they receive before any carry? And how much does the GP take in the catch up? And what's the remaining profit split when you divide whatever that's left between 80 and 20 split? And what is the general partner's total carry, and the limited partner's net returns, or multiple on invested capital? So that's one question for you to really think about. And like I said, if we have time towards the end, I might jump to that Excel bit of it. But anyways, we don't really want to have too much in a simple webinar. I mean, you're free to take a screenshot of this or just note down the details. I'll wait for on this slide for a bit. All right. Yeah. Now this is just, how much, the interest that you end up earning is going to be classified under UK and US kind of laws. Uh, So UK, I think they've just changed. So it's not going to be an interest income. It's going to be classified as a reclassified rather as a trading income. So earlier it used to be about 33 or 32% capital gains tax. Now you end up paying almost 44 or 45% tax. And US, I mean, they've still classified it as a long-term capital gains tax but if your holding period is, sorry, up to 3 years. So that's the kind of jurisdiction play is what you will have to work around while ensuring that the structuring uh, stages while you're at the structuring stage. Now, the idea is that though it's sort of a flux, but that flux really translates into where our expertise lies, and that's where our advisory kind of prowess really kind of shines. Sorry, that's just to give you a broad overview. Yeah, and at the exit, what's the kind of work that we can sort of do as an employee? uh, Fund controller running distribution waterfalls, clawback tracking, and everything from fund management accounting to the final exit calculations. Second, valuation specialists make the book under fair value standards and tax analysts. Just what we've seen in the previous slide. Member in practice, independent valuation, independent computations, uh, 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 you know, uh, sort of a lot of outsourcing work on fund management accounting as well. So that's one area which is sort of really growing, and I've not seen so much traction on the Indian front. Cross-border carry structuring advices, what we've seen in the previous slide, and vendor due diligence, exit readiness. If you're advising on the IPO, I'm sure a lot of us have clients ready for IPOs, at least on not on the main board, but at least on the SME part of it. So that's one area where we can sort of really shine, and it's just about just being out there and just getting things sort of started for us. So that's one. Yeah, the main question, which is what's in it for us. So I think I've uh, talked about through the various channels and various stations altogether, but then this is just sort of like a summary slide for you out there. So member in service, member in practice. So for each stages, this is the kind of progress which we can sort of offer. So I'll spend some time on this slide here. Okay. GCCs, I think it's a topic for a separate time. And yeah, so just on where we can add value. This is just detailed kind of a listing down. I mean, I'm happy for you to take a screenshot or just note these pointers down. So I mean, whatever sort of pays off for you, I'm happy for you to engage. Yes, and this is one question which sort of gets asked a lot, especially on the employability side of members in service, which is we have the base of CA, what more answer is, I'm sort of biased towards this qualification, so my answer is always that's enough. So whatever that we end up building is just, on our existing principles, work ethics, our technical knowledge, and of course our ability to sort of sell and be out there and just get the maximum for us, be it a promotion or be it a job outside India or be it a fee paying client who's based in UK, for example. So that's just for us to build upon, but the base has always been very stable and very solid. But then, let's say if you are looking for prospective employability in a fund management entity in IFSCA or in GIFT City, this is one mandate which I think, like I said, I think August this year or September this year is the deadline for this certification. So if you're getting a job before that, so your HR or your manager is going to just help you with it. But that's one area which you will have to sort of look forward to. But then, do you need a CFA or an investment fluency? I think the answer is only investment fluency. And, we've had that, that kind of educational background of analyzing uh, everything from structuring till exit till valuation. So everything that we've studied so far is and will be put to use. So, do you need a CFA? Answer is no. You just need a simple investment fluency. Like I said, it's a different world on the private capital side. And when I say different world, it's just that the kind of language that they end up using is a lot more different than what they end up or what we are used to on a public market spaces. So investors are called LPs and fund managers are called GPs. So it's just waterfall structure, hurdle rate, and all those kind of things. So we just have to get used to that lingo and those broad simple calculations. And I think that's broadly what sort of fits in for us. And I yes, so if you look at the last point, the platform fluency, which is, do you need to have prerequisite knowledge of Bloomberg databases, or let's say ProVis IQ or Capital Line, or let's say FactSet or Capital IQ by S&P? The answer is no, but at least if you have that kind of an inquisitiveness of you know trying and testing those new platforms, if you have that kind of an open mind, you'll be able to sort of gel in really very quickly. But if you come from that, I don't want to use the word traditional, but if you come from that very very rigid kind of a mindset that I don't need Bloomberg database, or I don't need ChatGPT to tell me what has to be done or what cannot be done. So I think that kind of rigidness is going to really, especially now in these so fast changing times, it's going to probably come in your way. But do you need a prerequisite Bloomberg database, for example? Answer is no. It's really very easy to use, and once you get access to a Bloomberg database through a client or through an employer, I mean it's just going to take you very little time to just get used to the ecosystem. That's it. Yeah, the compliance alphabet. So each acronym is sort of a billable mandate for us, which is FATCA, CRS, AIFMD for Ireland or for Europe, for FEMA, ODI, OPI, GAR, PEPS Pillar 2, and your anti-money laundering and KYC. We cannot really end any discussion without bringing AI into space, but I think there are other platforms which ICI uses very diligently to ensure AI literacy is really very present amongst our members. But like I said, if you're just able to have that different mindset, uh, you know, of just being a little more open in adopting these kind of platforms or these kind of tools, I think it really sort of you know acts in our benefit. I don't want to brag about this, but I end up using a lot more AI tools now than I used to probably even 6 months back. And I came from a very similar mindset about 6 months or a year back, suggesting that I mean, who the hell are these, AI tools to really tell us what to do or how this can be done, or, I mean, how is it really possible? And, I come from an academic background as well. So, when I see my students using AI tools, I'm just like, you can never beat me, right? So that's the kind of, that's the kind of sway which I had for myself, that, it's really impossible that, Google search is going to be, lot more or lot less efficient than, let's say, an AI search. That's the mindset which I came from. But then somehow, somewhere down the line, I sort of tried and experimenting things over the last year, and especially over the last 6 months, I've been using AI tools like insane. So, be it for deal sourcing or just seeing where transactions are happening. So I train that model a lot on a lot of these numbers, a lot of these reports which come in, and a lot of these public numbers as well, and give a lot details on my clients or the kind of companies that I'm sort of dealing with. And I would just put it overnight. There's something called as, like code share or a co-working, like an AI tool, like an agentic tool, and just do it overnight. And by the time I'm sort of woken up in the morning at 6:30, it's just out there. And I just, first thing that I do is, while I'm sort of having my cup of tea, I'll just read through whatever that the work that the tool has done, and I just have a head start. So if you're really looking forward to, it'll do our job in and out, that's not possible, but it gives us that head start for that initial or the preliminary research. And that, I think, has been more favorable to me than just, outsourcing everything from pin to piano to these tools. So that initial preliminary head start, it's really, at least for me, it's acted so far insanely. But you know I mean, two things which will always stand out for us, irrespective of, Claude launches Fable 5 or Mythos 5 for retail as well. It's not really going to matter on two areas, which is, one is judgment, what we think is right, or our intuition part of it, which can only come if we, understand our client, our job in and out. And second is, the human relations, which is, just being out there and being for your client, or being for your team, and it's just going to pay off. So that's my bit on it. Yes. One last exercise, I think, before we can move on to Q&A, which is, I'll not spend so much time here, but it's just for you to sort of spot on, which is, let's say, Singapore-based GP is launching a 150 million US dollar denominated India-focused growth fund in GIFT City. First close is in 90 days. Anchor commitment from Gulf Family Office, and target is 12 minority stakes in consumer healthcare companies. 5 to 6 year, that's your holding period. Exits either via IPO or strategic sale, right? So this is your total mandate. Now, what kind of work which you think that we can get out of this transaction? I mean, I have the answer right immediately in the next slide, but I'm just, like I said, I'll spend about 10-20 seconds. Yeah, so that's mandate hiding for us in plain sight. Like I said, this is not end to end, or this is not all inclusive. This is just, still, let's just oversight of what can be done out of a simple transaction, which you just heard, somewhere on a flight, somebody sitting next to you, or, you're just talking to somebody in a conference, and this is the kind of, conversation that you've had. So these are the services which we can offer. Whatever that you can offer, I mean, you're just happy to pick up that and just start working on it. So yeah. So I think I'll rest my case here. And yeah, I have added, I don't think we have a forum here to share people's own daily stories, but I think you can use that chat box, and somehow it'll come to me, and I'm happy to narrate it on everybody's behalf. So yeah. Thank you and happy to take questions.
So we have received some questions from the participants. First question is, so what CA criteria is there to become a fund manager in AF2 at Gift City?
So there is no minimum requirement. So every openings that I'm seeing is broadly you need to have a CA or a CS qualification. That's one. Second, like I said, the IFSCA mandate certification is due, I think, August end or September end. So that's one additional which you have to do, not before you get employed. So if you are a C member, I'm guessing you must be a C member because you're asking this query here in this platform. So qualification wise, you don't need to do anything. But if you don't have a prior experience in, let's say, fund management entities or fund accounting or just compliance of these entities, uh, Gift City really looks forward to employing people with some kind of a background experience. So uh, if you are able to get it, let's say in a city like Mumbai with, let's say Kotak Mutual Fund accounting for the matter with somebody with a 0 to 2 years of experience, I think I would recommend that you do that first before you go to Gift City. Gift City, I think the work is just going to come to you in full force, and you will have very limited team to really manage. So I think prior experience is what's going to help you. That's not going to stop you, but going to really help you.
Second one is, how Gift City is better than any other countries if sole purpose is investment?
So I mean, that all depends on where the fund ideally would like to deploy itself. So for example, let's say if it's a London-based fund manager with a US passport, uh, but wants to invest in Asia Pacific or Southeast Asia and with India as a focus, so Gift City becomes a national choice. If there's a fund based out of Africa continent or Australian continent, which will need some kind of a little bit cheaper structuring requirement, so that's where Gift City can ideally help. But let's say if you are a US based fund and you're really looking to invest only in China or only in Europe for that matter, so then Gift City would not play any role whatsoever. So if there is some kind of an Indian mobility aspect to it or Indian deployment aspect to it, that's only where Gift City is going to stand out. But otherwise, it's these larger players and older players will take away the share from us.
Okay, sir. Next one. How feasible is it for the government of India to make it compulsory that all exist will be a present combination of private market and public market transactions?
Hmm. Um, I think I'll take this question offline because there are a lot of nuances which uh, you know, I will have to sort of go through before I can answer. And I think I'll take this question offline.
Yeah,
So
yeah, yeah,
if somehow the committee is able to pass on this question, I'm happy
yeah.
to take it.
Okay, sir. Next one. You called Gift City India's accelerant, but let's be honest, is it genuinely competitive with Singapore and Cayman yet, or is some
Hmm.
of this hype? Where would you still tell a fund not to use it?
Okay. Um, I know, I mean, I don't really want to get in trouble whether, to sort of really answer whether QCT is real or hype. But, like I said, it was a request which I'd made to all the members, sort of listening to this is you just go to Gift City once and just see how accessible it is to the airport, to the golden quadrilateral, the sort of supply chain sort of aspect works very well to it. And of course, the kind of work that the regulators are doing at the IFSCA, I mean, it's just insane. And I mean, my personal experience with the regulators at the IFSC has been so solid that I mean, I remember I've been calling them for some kind of a follow-up at 10:30 in the evening, and they will still pick up and they will still answer your calls. So I mean, it's just the entire ecosystem has been built for that push for a like a structuring plus one kind of a strategy. But is it real? Answer is yes. It's very much real. I think a last real estate deal which just made headlines was 15 or 17 crores, which I think Shivali Group sold a residential property to an NRI or something. So that's answer is it's real. And secondly, to answer on the point, where do you use it's if there is some kind of an Indian kind of a linkage which the fund or let's say any other business, let's say if it's a fintech company wants to ensure, because India really provides that large consumer base which no other country can really sort of offer. So if it's a fintech company or if it's a let's say a wealth management platform which you really want to test waters with the kind of diversity that we have in India, then yes, that sort of becomes an ideal choice.
Okay, sir. Say I am a chartered accountant in this audience, sitting in an audit or finance role. It's Monday morning. What are the first three things I should actually do to move towards this world?
Hmm. So, I mean, the very first is I've tried to divide this entire sort of talk into four stations or 4 points. So you'll have to pick up one station and just sort of make your next god and just follow that path. I mean, it's really hard for anybody to have an entire oversight from station 1 to station 4. So you can only do exits, or you can only do deployment, or you can only do structuring. But for one individual to for it to happen, that's going to be really hard. So this way is pick up one area, it's a structuring, and you just build your knowledge for it or your experience for it. Now, depth is what I've seen so far is what will really get you hired. Now, if you typically look at all these, let's say private capital giants for the matter, like Blackstone or KKR or BlackRock for the matter, they would ideally look for people with a lot of prior work experience, a lot of leadership in these fund management entities. So that kind of depth in knowledge is what's going to really stand out. Uh, that you will have to figure out, I think, company to companies, what kind of additional certification or additional credential is what is going to make you stand out. Probably that's second. uh Third, I would say is I mean, just to network with the people out there. So figure out a conference. So there's this union called IVCA, Indian Venture Capital Association. There this forum by VCC Circle. There are a lot of these private equity, private capital, private credit forums which take place globally. So if you're somebody from North, private capital is where you have very easy access to, because a lot of investors family offices are from the part of North. And that's networking, or these kind of people management skills is what you will have to sort of sail through. So I would say pick up a lane and just start going, build as much depth as you can, and just meet people out there to see where and how things really function.
Almost everyone here is a CA, and many are wondering whether to add a CFA, the IFSCA certification, or something else. If they could only add one, how should they choose?
Perfect. So I think we had a slide on this as well, and thank you for asking this again. So the IFSCA mandate certification is what you will have to take if you're planning a job in GIFT City, or if you're planning some kind of a work in GIFT City specifically. But you still have about a quarter's time or so before you do that. But let's say comparing it with CFA, no, you just need that investment linguistic knowledge, or that investment philosophy knowledge, and you'll sort of sail through. So the for the sourcing part of the station, we don't need anything else. But for the structuring part, if let's say you're somebody from, let's say, internal audit, and you want to move towards structuring part just because it looks to it looks so exciting for you, then I think not I think ICI has a lot of these certification courses on cross-border compliance, cross-border taxation, international taxation. I think it has a course on structuring as well. So, and of course, independent valuation and those areas. So that's one way which which you can just use to just brush up your knowledge and just get those insights from the trainer, from the faculty. And uh, I mean, for the structuring part, the best way is to start doing some kind of work. So get associated with a CA firm or a practice, or somebody who's into this kind of outsourcing work as well. And I think, I mean, it's like I said, I'm sort of biased, and the base that we have, I think Suraj, you'll agree as well that the base that we have is just really very strong. So we just have to layer a bit.
Okay, sir. So next one, let's address the fear in the room. With AI due diligence 20 times faster and writing first draft fast draft reports, are we training people for jobs that won't exist in 5 years?
uh, I mean, the fear is real, and sometimes even I get those nightmares that what if this happens? So do we have enough buffer? I mean, forget the money part of it, but what are we going to do day in, day out, and how many times that you can visit Goa in a year? So that's the kind of question that sort of keeps me awake as well. But uh, you know, I mean, two areas where we can always stand out. One is the decision making process, the intuition part of it. So that's one area where I think we can play a phenomenal job for that front. And second is just human relations. So that's you know uh, I mean, I was just discussing this yesterday with my wife that do you chat with AI much more than that you talk with me? And somehow it turned out the answer was yes, that I do chat with Claude and ChatGPT much more than that I do with my wife. So that's true, but uh, I think that human relations part of it is where we can, I mean, the networking, that understanding the client and those kind of nuances, that's where we can stand out. And eventually, once this hype is sort of little cooled down, you will need a fellow human, for advising or for things that you can't really share on public platform. That's where a CA or a doctor would step in and give you that, you know, that secretive, perfect advice.
Yes, sir. One question from our member. As a fresher CA qualified in August 2025, attending today's session, I am highly interested in entering the PEVC domain, but I am facing zero responses from employers. What exact practical skill or certification should a fresher showcase on their CV to clear the initial screening round at PE or VC firm, given our lack of prior deal experience? So, as I'm from IDT background and looking for job in this area.
Okay, I mean, thank you for posting this, and I'm glad that you're so honest. I think we just have a minute, so I think this probably be the last question. But uh, yeah, if you try those giant names, it's going to be a lot more difficult. So, I mean, if you remember the advice that I'd sort of given out during the lecture, which is you would want to try these NBFC routes. So let's say KKR would have its own private credit or a NBFC setup. So that's where it's much more easier to get into. And like I said, typically these PE or VC firms or these private spaces would need a lot of work experience before you can actually relevant work experience before you can actually, be out there and do some great deal for them. So if you are able to get jobs, let's say in equity research or those mid-market space investment banking firms, I think that's going to eventually make or carve out a career for you eventually on the private space. So don't really start out with private, start out with public, or start out with these NBFCs or these uh, regulatory compliance for these funds, so that they'll pick up once they are looking for somebody, and that's going to be you. So good job for that. I mean, good luck for that.
Okay, sir. Uh, that's the end of Q&A session. As we come to the end of today's session, I would like to take a moment to reflect on the valuable insight that have been shared with us today. On behalf of the ICI Global Udan webinar series, I extend my sincere gratitude to our esteemed speaker, CA Harsh Thakkar, for taking the time to be with us today and for sharing his knowledge, experiences, and valuable insight. Sir, your session has been both enlightening and inspiring, and we are truly grateful for your contribution. I would also like to thank all the participants who joined us from different locations and actively engaged throughout the webinar. A special note of appreciation to the organizing team, the committee members, and everyone working behind the scene whose efforts ensure the smooth conduct of the session. With that, we conclude the 42nd edition of the Global Udan webinar series. Thank you once again for joining us today. Wishing you all continued success, good health, and professional growth. And at the end, I just want to leave you with a quote. The future of finance belongs to professionals who continuously learn, adapt, and create value. Let us embrace these opportunities and lead the way forward. Thank you, everyone. Have a wonderful day ahead.
Thank you.